In terms of what's going to drive multiples for stocks going forward from here, you are talking reasonably positively about the economy. How does that translate into earnings? How strong do you think the earnings picture is going to be? Because earnings were pretty flat last year. Input costs have the potential to rise this year. The middle of the P&Ls could be affected by this. You could see input costs coming through from wages. Productivity is not picking up at this point. You could see input costs from other factors coming in. How finely balanced is it?
Well, I mean, before I answer that, it's worth saying that there's no correlation between 12-month returns and expected earnings in the stock market.
Fair enough, yep.
And there's no correlation between actual earnings and 12-month returns. So,
at some point, earnings have got to show up.
They matter over 3, 5, 10 years, sure. But I think the reality is, if I'm right and the global economy is going to re-accelerate, then earnings growth is going to do better than people expect. So, as you know, the consensus is pretty modest growth this year at the moment, if I remember correctly. And I think they could easily beat that to the upside. But it doesn't really matter. I mean, whether it's multiple expansion or earnings growth, in a sense, that's kind of the output. It's the liquidity that drives it and the cyclical momentum in the global economy. And that's really what matters. And both of those, I think, you've got at the moment.
There is a view in the United States that you want to be divested around the world this year, that Europe is going to be a little bit of an outperformer, maybe not from an economic point of view, but certainly from a market point of view, simply because of the valuation mismatch. Byron Wien was kind of pouring a little bit of cold water on that earlier on. What do you see coming out of Europe this year? We've just seen the European close. What kind of performance am I going to get?
It's a very good question. I mean, I think Europe's interesting on a sort of 3 to 6 month view because it always benefits when the global economy has a cyclical bounce. So if we're going to get that, as I think we are, Europe outperforms. But I wouldn't buy it on a valuation basis. And in fact, I can make a valuation argument the US is actually cheaper than Europe.
Go on then.
Which is basically done if you sector adjust and look at a median PE ratio. Of course, what we forget is the sector weightings in the US are much more tech heavy, and in Europe they're much more sort of value heavy, utilities, financials, well, less financials than it used to be, but those sort of sectors.
But the
so
US
if you adjust for that, the
looks
US
better.
actually looks cheap relative to history and relative to Europe.
If you just took a look at the averages, though, Europe is trading much closer to its long-term average. What does that tell us about, even if you put the overlay, the sector overlay on top of that, what does that tell us about what last year delivered and the kind of momentum that we've got going into this year?
Well, I mean, valuation is not a great judge of short-term movements in markets. It's not a great predictor of where the market's going to go in the short term. When you've got an extreme relative valuation, it can be helpful. But yeah, sure, if you look at the S&P 500 and a forward PE ratio, it was at 13.5 times at its low in December 18. It's now at 18.5 times.
Nearly 19,
so
yeah.
So it's a big move. It depends, it depends on what sort of forward. But yeah, so it's a big move in the PE ratio. So, that might concern you. But, as I said earlier, I think it's about liquidity. This market is not about valuation. Yes, I would like a bit of Europe as an overweight for the short term. It's an interesting trade because of the cyclical bounce. But I wouldn't fall in love with it.